I'm here with Daniel from Prerequisite Capital Management, and we've been talking over the past couple of videos around some essential concepts, generating investment returns, and our last video we talked about watching the behaviours of people and managing and being able to
where
read
money's
into
moving,
all
the underlying structure of markets.
And so we're kind of diving a little bit deeper again into some of the other elements of this.
Yeah, so the underlying drivers. So money moves for a reason.
Yeah.
You know, and even when we talk about capital flows between regions of the world, it's usually moving because there's differing growth and inflation expectations in each of the different regions of the world. And so capital wants to move where it's going to be treated best and rewarded most, you know, wherever the growth prospects are the best, as is perceived at the time. And the inflationary dynamics, you know, on a relative basis, everything, especially when we're talking capital flows or currencies, it's a very relative world. It's something compared to something, and there's a judgment call and a behavioural dynamic kind of at the heart of that. And so we want to dive in a bit deeper and particularly pay a bit more attention to growth and inflation. Now both of them are kind of loaded topics, especially inflation as a topic. I mean, we've written some pretty extensive first principles documents over the years, really drilling into where growth comes from, what all the different forms of inflation are, and sort of disentangling a lot of poor thinking on those topics.
Yeah.
Now obviously today we're not going to go and do all of that. We'll be here forever, but we still, you know, we need to gain an understanding of where we're at presently in each region or each area that we're analysing in terms of growth and inflation. We also need to get a bit of probabilistic sort of leading insight as to the way conditions might be unfolding, you know, on a cyclical level, and even some of the sub-cycles that can occur, especially from a reflationary type sub-cycle that tends to prevail quite a bit, at least in the regime over the last 20 years. So a bit of a sense for diving into just understanding leading indicators and also trying to understand the pricing structure. What this enables us to do is better understand the pricing assumptions embedded into any given market.
Right.
So like we keep saying, you know, insight gives rise to a degree of foresight. If we can have a look at what the assumptions are embedded underneath any given pricing structure in a market, we can just simply assess, well, are these assumptions reasonable or not?
Yeah, great.
You know, according to a broader understanding of a, you know, systems view of the world and just some basic first principles and even just a reasonableness test. And then we can triangulate that with behavioural extremes, with participant groups or whatever it is. And because if we can identify a situation where a particular assumption around growth or inflation is a little bit too rich and probably too extreme and got a bit carried away with itself in the pricing structure of a particular market, whether it's yields or equities or whatever, then that starts to signal a higher probability opportunity or risk, you know, around that assumption being exposed to be poor as time unfolds. You know, and that's one of the rubs with everything. You know, we're free to choose to believe whatever we want, right? And as a society and as people, we frequently do just choose to believe in all sorts of different things. They might not be coherent, they might contradict, but we don't get to choose the consequences of our beliefs.
Yeah, great.
Right, and so it's the same in markets.
There are fixed consequences.
Yeah, there are actually. It's like gravity. You can choose to disbelieve gravity, right? And you're very free to do so, and you might really convince yourself that gravity actually doesn't exist, but you can't control the consequences of, you know, when you act on your belief, gravity is going to reveal that it actually exists and has sway. It's the same in markets, so we assess the beliefs about a particular topic or issue or whatever that's unfolding in the world.
Right.
with a view to historic precedent and just the first principles understanding of how things kind of work and how things are interconnected. And we can assess the probable realities or how those beliefs are likely to unfold. And if we can triangulate that with information of flows and pricing and different things, then that gives us a three-dimensional view of what is likely going on in any given market, which is very empowering.
Gives you the ability to front run it.
Yeah, and to lean into certain asset classes or against, and on a cyclical or a sub-cycle or even a structural skew in the portfolio, right? And that sort of thing is quite invaluable, especially, we've talked before about collateral assets and confidence assets and even currencies. And, this all triangulates into a reasonably simple course of action when all is said and done, because this world, there is a law of non-contradiction that actually exists.
Yeah, I was about to ask you about that, Talk to us about that for a minute.
If you've been trained in logic or anything else, you know that, in fact, one of the hallmarks of a good analyst or a good investment thinker or a good scientist even is that there's a coherency to their thinking and to even their worldview or whatever their area of expertise. As soon as you start to identify that there's contradicting beliefs or thoughts or differing dynamics in however they think this field works or this operation works or this issue, you're starting to identify basically lazy thinking or thinking that has stopped past a point and they've just substituted just a firm belief in something. Apart from, most of physics is all about taking the law of non-contradiction very seriously.
Yeah.
And they distill all of this complex world down into fewer and fewer core drivers of what explains everything else. Taking that very seriously is quite a taskmaster when you're trying to work out a situation or some issue in society or this law of non-contradiction, because you can't just say, oh, well, that's crazy, let's just ignore it, or that market's nuts. What is the functional understanding? How is that just an adaptive expression of this core system or dynamic? And when you start to scratch beneath the surface of these apparent contradictions, you end up into just stumbling across greater insight and understanding as to what is actually really going on. So there's a particular community in the investment world that get very hung up on certain ideas, and in that particular community, a lot of analysis ends up being, whatever the issue is or whatever the dynamic or whatever, ... therefore the conclusion is buy gold.
Yes,
right?
yes.
And what happens, they're very prone to just, okay, that's insane, or this expression is crazy that they're seeing in a market or in the functioning of a system, and they're actually right at some level. It is actually insane, it is actually but their thinking stops, right? Because they've just labeled it as nuts and they've moved on. Or that market's so overvalued, that's nuts, not touching that with a 10-foot pole. But because their thinking stops, they don't dig down into the system sort of substructure that is actually causing that expression. So they miss the capital flow feedback loop that takes it from insane to totally ridiculous.
So the observation is correct, oftentimes.
At a surface
level, but as you dig down,
yes,
there are underlying assumptions.
And part of that is they're willing to tolerate contradiction.
Right.
And also they don't dig deeper into their own understandings and worldviews.
Or understand their own bias.
Yeah, or they're not trained to actually analyse a system anyway, usually. Not many people really are. And there's the few that are usually trained in the natural sciences, right? Computer science, programming or physics or
talked about that
whatever.
In the previous video.
Yes, that's right. Yeah. Whereas in the social economic systems we're in, there's thinking participants. I perceive the fact, I think about it, I act out a feeling or agenda or whatever. It's just free will. I act, but then that changes the reality that I observe, and it just gets all funny, especially when you're doing this across multitudes of people.
Yeah.
And so it's a very unique, complex system that you need to analyse and disentangle the contradiction. So anyway, the reason we're talking about that is those fields or any grey areas are usually ripe areas for study, right? And you actually want to target the grey areas in their understanding, because usually it's ripe with potential opportunity for insight and all sorts of things. In fact, jumping ahead, this is a classic example. So most people appreciate that when there's the quantity of liquidity or the quantity of money that's created, particularly in the banking system, everyone knows there's a circulation dynamic going on, or even a money demand that broadens out. So quantity just doesn't tell you all of the story, basically. You need to understand what the demand picture is going on, or the circulation dynamics, with regards to that liquidity. But how do you define that? Like, most of the thinking is stopped at a conventional academic level, and velocity, or the circulation of liquidity, simplistically, that thinking stopped at a GDP/M2 type definition. But even that doesn't really define things very well or usefully. And then how do you apply that to a world where liquidity is created, and purchasing power and cash equivalents and all of this sort of stuff in such a broader array of fields in the global financial and banking system, that definition is just insufficient.
Yeah,
and
absolutely.
so, wow, that's a grey area in most people's thinking. Let's spend more time on that. And when you study the banking system and how it all works, because every single line item on a balance sheet or a financial statement from all the major banks aggregated in the world has a behavioural cue to it, or information content. All right, it's like everything about you says something about you, whether you realise it or not. Same with all of these different myriads of line items. So people have rarely really dug into what all these different line items really mean, and how do they fit into the functioning of that broader system. And so you can find behavioural cues and all of this sort of stuff. And so that led to an understanding of velocity in global banking systems dynamics, which really unlocks a lot of stuff. Like, there's no coincidence that in 2014, when global banking system, like the velocity of liquidity collapsed, that then led to and coincided with the increasing appearance of negative bond market yields in increasing amounts of countries in the world. Yeah. And even that negative bond yield type phenomenon that really kicked off in earnest in 2014, that's symptomatic of deflationary, disinflation issues really kicking in, which is sort of the other side of, almost by definition, a velocity collapse. Right? But see, we're getting probably too far down some rabbit holes, but that's an example of a concept that people tolerate and really don't dive into enough.
Talk for a minute, I guess. We've talked a little bit about the law of non-contradiction and some of these principles that you apply in assessing where things are at. There's this idea of needing to maintain leading indicators on growth and inflation in the major markets in the world.
So most people are aware of leading indicators, especially around growth and economic activity. Now, we have a few little tricks we've stumbled across and learned over the years as to how to do this well, because it's all about deciphering signal from noise and having a timely or a leading high probability sense for where conditions are evolving, ideally just slightly before everyone else kind of picks up on it. Good leading indicators need to be grounded in common sense. They have to be timely, they have to be fairly robust. You can't be held hostage to say government or government departments to produce and release data sets and all of this sort of stuff. There's a particularly large Asian country that is renowned for funny economic statistics and financial metrics that they release that tend to suit whatever their political agenda is at the time. So as analysts, we really need to get to the heart of what is actually happening in all of these different areas.
Absolutely, clarity.
Same in the US, same in much of the developed world as well. And so we need to be able to develop leading indicators that are not necessarily dependent and vulnerable to agendas swaying the data, even the release or corrupting the integrity of the data that is being measured and collected and all of this sort of stuff. The concept of a leading indicator is simple and everyone kind of understands it. The practical application in how you build these things and source them and then understand them, it actually gets quite tricky quite quickly.
So
it's a bit more involved than
there's
the surface
limitations
level.
in the way in which many leading indicators.
But this is the constant theme, right? With all of the different tools we have, individually they're all kind of imperfect,
right?
But they're still very useful. But when you put them all together and you're glimpsing reality from multiple perspectives, it starts to, a similar underlying picture tends to emerge and you gain conviction that you're accurately observing reality, which means you can then act with more confidence. Still got to be cautious because, you know, we're not God, we don't have perfect knowledge. And so we remain humble and open to different scenarios and all of this sort of thing. But that's part of the risk management framework that comes with all of this stuff anyway.
Yeah.
We might just quickly run through a few practical examples.
Yeah, that'd be fantastic.
Just to give a sense, because some of the indicators or leading indicators around the inflation side of things are quite interesting and unique. Most of the growth leading indicators are fairly stock standard. There's different things you can measure. Some involve financial markets as leading indicators, some don't. And you just need to know what's measuring what and where it's coming from because it all paints a three-dimensional picture when you really dive into this stuff. But ultimately it needs to be historically robust and give you all the right signals when you really needed them most of the time. And anyway, standard sort of typical leading indicator type theory. This is actually China. And so even the leading indicator, or one of the leading indicators we have, obviously needs to source from a further variety of sources and publishers of data and all of this sort of stuff, both market and non-market data. Because China at times can be problematic in the sort of data it releases and the timeliness and all of this sort of thing. And China in particular is a pretty significant player when it comes to assessing global conditions. Yeah. But that's a good example of, and this is where the systems perspective really comes to the forefront, because systems thinking and training teaches you to triangulate insight into things that you don't have direct observation of.
Yeah, that's right.
So you learn to be able to see a series of symptoms or expression effects of something and triangulate what is really going on at the core.
You can get to the root cause.
Yeah, half of these tools and different analysis methodologies and frameworks that I've been able to evolve, I'd never have been able to do it if I hadn't been trained in systems thinking, because it teaches you how to take all of this expression and get to the really core heart of what's going on and the dynamics that explain everything else. And so this is an example of one of our inflation leading indicators. So there's inflation expectations that are embedded into bond markets. In most of the developed world, there'll be nominal bonds that are traded, but then there's these inflation indexed or inflation linked bonds that are traded.
Yep.
Bit of a discussion for another time, but when you look at the bond markets, you can literally see in the way they're priced what the break-even expectations are that the market is pricing for the next 10 years or whatever the duration of the bond is. The problem with that is that, like, even in the US, they only started trading, the inflation-linked bonds only started trading in, like, you know, the 1990s. So we don't really have
Data.
information preceding that. But understanding inflation expectations that are embedded in capital market pricing is essential, especially to be able to assess conditions and all of this sort of thing. But then using a systems perspective, you can triangulate the inflation expectations sort of pricing within the capital markets that did exist, going even all the way back to 1920. Like in different fixed income markets and equities and all of this sort of thing. And so then you can triangulate and strip out what those embedded inflation expectations are, right? Just simply out of capital market data, in the same way that we're stripping out all sorts of information about flows and this and that. It's sort of a similar concept, but to inflation pricing. And anyway, so you can see here, so all of this is expanded on obviously in great detail in a lot of our reports and all of this sort of thing, but you can see it basically in grey is our capital market implied inflation expectations sort of data set. It's very much a leading indicator. So this is the commodity index in blue. This is US in orange, consumer price inflation or consumer price index as a year-on-year annual inflation proxy. And so basically, going back to the 1920s, we can literally see the implied inflation expectations and the directional importance, which leads, coincidentally, most of the major trends, cyclical or otherwise, in commodities and inflation and all of this sort of stuff. So learning how to take that systems view and triangulating down into the very core dynamic of what's happening. And the same thing applies with people and behavior and organizations. The same principles, just applied in a different context.
That's amazing.
Yeah, which is also helpful for China, right? Because they don't really have inflation index bonds trading and all of this sort of stuff, but they do have other capital markets that are trading and functional. Yeah, it's a bit unique in China in that there's still a very heavy state type footprint even in their capital markets, but it still works, right? And the implied inflation expectation methodology even applies to China. It's a double check on every other region of the world, and you can start to see the leading trends, and this leads most of the important swings in even Chinese inflation and other different issues. But it all sort of, it just builds this three-dimensional picture, having all of these different tools to measure abstract ideas in data form.
Yeah, great.
You see when it shifts and all of this sort of thing. And so, there's no singularly perfect data set or model or tool or indicator or whatever, but most of them are useful if they're grounded in reality, they're timely, they've got a bit of common sense about what's going on, how they're constructed. They paint that three-dimensional picture, which at the margin, at least in our mandates that are more conservative, helps us to know where to lean into and against to sort of increase the compounding of returns over time.
Great.
And so in that way, with all of these principles and tools and processes, we can be resilient, largely irrespective of what happens is the aim. But at the same time, by kind of learning how to lean into or against different asset classes at different points in time, using the collective sort of insights that are garnered by measuring all of these different phenomena and knowing how to tie it together just with first principles and systems thinking type understanding, it helps us to take those returns from just, preserving capital and maintaining purchasing power and actually increasing that, to being able to compound at a higher rate of return over multiple years and, do it consistently and on the basis of process and strategy instead of just, luck. Anyway, the more you prepare and the more you dive into all of this stuff, generally speaking, the luckier you tend to be, but, it's still a complex world out there.
Over the past few videos, you've definitely given us an insight into the way in which you think, into the way in which you assess. And I think, like you said before, there's so much more information that you provide in your reports that are available on your website. And if people want to dive deeper, they can get a hold of them. But this has been a great foundation, I think, for a lot of people in understanding prerequisite and the way in which you work as a team. So thanks for your time. It's been great to get to know you guys a bit better.
It's been good.